You swipe your card. The payment goes through. The number on your banking app doesn't change much. Feels normal. Comforting, even. Now here's the uncomfortable part. That money you think is sitting there, it isn't. Not waiting, not resting. Not yours in the way you think it is. In the moment you truly understand who owns it, you'll never look at your bank balance the same way again. Let's start with a simple scene. You walk into a bank. Glass doors, security guard, polite counters, logos designed to scream stability. You deposit 10,000 rupees or $1,000. The number doesn't matter. In your head, this is what just happened. You handed money to the bank. They're holding it for you. Like a locker, like a vault. That's the mental picture almost everyone has. It's also wrong. Legally, the moment your money hits the bank, ownership changes. You no longer have money in the bank. You have a promise from the bank. A promise to give you money later when you ask for it. Subtle difference, massive consequences. Here's the real transaction that just took place. You didn't deposit money. You loaned money to the bank. Unsecured, low interest, callable on demand. You became a creditor, and the bank, they became the owner of that cash. That's not conspiracy. That's the actual legal structure of modern banking. If that sounds insane, good. It should. Because once you see it, the whole system starts to look fragile. Let's break it down without jargon. Banks don't make money by storing cash. They make money by using cash. Your cash. The moment your deposit clears, the bank is free to do three things with it. They can lend it to someone else, they can invest it, or they can use it to cover other people withdrawing money. Usually they do all three. And here's the part almost no one realizes. They don't keep your full amount available. Not even close. Most banks keep only a small fraction of deposits as actual cash reserves. Sometimes 10%, sometimes less. In some systems, effectively zero. So if you deposit $1,000, the bank might keep 100 liquid and send 900 out the door. To a mortgage, a business loan, a government bond. That $900 still shows up in your app, but it's already somewhere else. This is not a glitch. This is the design. It's called fractional reserve banking, but forget the name. Just remember the effect. One pile of money gets counted multiple times. Your balance says $1,000. The borrower's account says $900. The economy now has $1,900. Same base money, two claims. And as long as people don't all ask for their money at the same time, the illusion holds. That last sentence matters, because the system only works on one assumption: trust. You trust the bank will give you your money when you ask. The bank trusts most people won't ask at once. History tells us how that usually ends. Every major bank collapse follows the same pattern. Nothing happens, then everyone wants their money. And suddenly, there isn't enough. That's not because banks are evil. It's because banks are leveraged by design. Your money isn't sitting in a vault with your name on it. It's circulating, working, earning, risking. For them. Now let's add a layer most people never consider. If a bank fails, you don't get your money back. You get in line. You become one claimant among many. Depositors, bondholders, institutions. In many countries, deposit insurance exists to calm this fear, and it works, psychologically. But think carefully. Deposit insurance doesn't mean your money was safe. It means the government promises to replace it. Different thing. Instead of trusting a bank, you're now trusting a government's balance sheet, which is funded by debt, taxes, or money creation. Again, promises stacked on promises. Now here's where the irony kicks in. Banks call your deposit a liability. That's not an insult. That's accounting. From their perspective, your money is something they owe,
Your savings account is their debt, and they aggressively try to manage that debt to make profit elsewhere. Low interest paid to you, higher interest charged to borrowers. That spread is the business. So when people say, my bank is holding my money, what they really mean is, my bank borrowed my money cheaply and is using it to make more money. Still calm? Good. Let's raise the stakes. Because in the last few decades, banks stopped being the only players. Your money now flows into complex layers you never see. Money markets, repo agreements, derivatives, sovereign debt. Your simple deposit helps lubricate an entire global machine. A machine that depends on constant confidence. This is why headlines about bank stability matter so much. It's not about profits, it's about belief. Once belief cracks, everything moves fast. Withdrawals spike, assets get sold, prices fall, panic feeds itself. And the irony? Banks aren't lying to you. The terms are written, the rules are public. We just never read them because the system feels boring, until it isn't. Now let's contrast hype versus reality. Hype says your money is safe. Banks are regulated. The system is stable. Reality says your money is a claim. Stability depends on behavior, and behavior changes under stress. Most days this doesn't matter. You swipe, you transfer, life moves on. But the moment stress enters the system, inflation spikes, interest rates jump, a major institution fails, ownership suddenly becomes very real. People don't panic because they're irrational. They panic because they finally realize the same thing at the same time. There isn't enough for all of us. And that's the quiet truth behind every financial crisis. Not fraud, not chaos, but math. So who actually owns your money once it's in the bank? The bank does. You own a promise. A very useful promise. A mostly reliable one. But still, a promise. And once you see money that way, not as a thing, but as a chain of obligations, you start asking different questions. Questions like, how many promises are stacked on top of mine? What happens if trust breaks? And how much of my financial life is built on assumptions I've never tested? Because the scariest part isn't that banks own your money, it's that the entire system works only as long as nobody thinks too hard about it. So here's the thought to sit with. If money is mostly trust, and trust is fragile, what happens next time everyone